If you're curious to know how a reverse mortgage actually works, you're definitely in the right place. In today's video, we will be exploring the three most important pieces to initially understand about this product when you are just beginning your reverse mortgage research journey, which is the basics of how this loan works, the eligibility and obligation requirements, as well as who this loan may be a good fit for. So let's get to it. Hey folks, and welcome. Taryn Proctor here with Retirement Home Equity Advisors, where we help folks with all of their reverse mortgage needs. If you're new here and learned something today and want to learn more, don't forget to hit that like button and subscribe to the channel. Subscribing just makes it much easier for you to access all of my reverse mortgage education content in an instant. All right, so reverse mortgages. Now, this loan is certainly one that has stirred up a ton of controversy in the past and is fairly complex. So it's understandable that many people are left confused and not really knowing what is what when it comes to this type of financing. And to add insult to injury, there is also a lot of incorrect information floating around out there about how this product works and what it's all about. That's why today I will be going over with you the three most important pieces that you'll want to initially understand about this product, which is again, the basics of how this loan works, the eligibility and obligation requirements, as well as who this loan may be a good fit for. And if you stick around till the end, I'm also going to be discussing who a reverse mortgage may not be a good fit for. For starters, I'm probably going to explain this a bit differently than most because I actually think most people describe reverse mortgages inaccurately, including those who originate them. Many times you will see reverse mortgages described as a loan that allows you to exchange a portion of your equity for cash. This insinuates that how much you qualify for is based on the amount of equity you have in your home, or that as long as you have equity in your home, you can get a reverse mortgage, which isn't necessarily the case. So if you've done any research about reverse mortgages so far and have seen them described this way, I want you to throw out all those ideas and start fresh. Now, if after you watch this video, you do want to learn more about how much you may qualify for and how that is determined, I'll put a link to a video I did on this topic down below in the description of this video. So what a reverse mortgage actually is, first and foremost, I want you to remember, it is still a mortgage. It is a loan that is specifically for homeowners who are 62 or older in the case of the federally insured reverse mortgage. And in fact, it is essentially a type of cash out refinance with very unique features that is insured by the federal government and allows you to cash out a portion of your home's appraised value, not the equity, the appraised value, and does not require you make payments on the amount borrowed until the last remaining borrower leaves the home. Now, let's break that sentence down a bit more in detail. First, let's go over the basics of a traditional cash out refinance. When you do a cash out refinance, depending on a few pieces of criteria, you will qualify for a total loan amount. Once that total loan amount is determined, your old mortgage and closing costs will be paid for out of that new loan amount. Then any remaining money in that new loan amount is yours to do with what you need. A reverse mortgage works that same way. Whereas based on a few pieces of criteria, you are going to qualify for a certain loan amount. Any liens or mortgages and closing costs will get paid for out of that new loan amount, and any money left over is yours. Now, similarly to a traditional cash out refinance, if you don't have sufficient equity in your home, a reverse mortgage may not be possible for you yet. This is where part of the confusion of the equity comes into play. What I mean by this is, let's say the amount you can qualify for with a reverse mortgage is not enough to pay off the mortgage that you currently have. Well, then that means you don't have sufficient equity and may need to wait until you do before a reverse mortgage is feasible for you. So we now have our reverse mortgage loan amount, our old mortgage and closing costs got paid off, and we have money left over. Now what? Well, this is where things begin to differ from regular mortgages. Once your old mortgage gets paid off and is replaced by the reverse mortgage, that means you now no longer have a required mortgage payment. Payments are not ever required towards a reverse mortgage, but you can choose to make payments if you'd like. In turn, though, if you choose to no longer make payments, which most folks do, you are choosing to no longer pay the interest that the mortgage is incurring. Now, every mortgage incurs interest, of course. It's just with regular mortgages, you're forced to pay the interest your loan incurs on a monthly basis. With a reverse mortgage, however, if you choose to not make those payments, that interest will simply get added on to the amount you owe back, also known as your loan balance, every single month moving forward. Ultimately, for most reverse mortgage borrowers, they have an increasing loan balance month after month, year after year, to which at some point, the total loan balance will become due, including the amount borrowed, plus all of the interest the loan had incurred over the years, when the last remaining borrower permanently leaves or sells the home. And we'll get into more specifics about when the loan becomes due once we get to talking about the qualification requirements. So, a lack of a required payment is the first major difference compared to regular mortgages. And the second difference has to do with the leftover money that you may have available. Of course, with a traditional cash out refinance, you just get whatever money in a lump sum, and that's it. It's a one-time deal. But with a reverse mortgage, although you can take the money in a lump sum, you also have the option to structure that money in a line of credit, take the money in automatic monthly payments to yourself, or you can structure a combination of all of those options. Now, there are certainly distinct pros and cons to each of these structures. So if you want to learn more about these options, be sure to subscribe to my channel and check out all of the other videos I've done previously that go into detail about all of these subjects. Now that we've gone over the basic structure of the loan itself, I want to take a quick moment to clarify a couple common misconceptions about this product before we move on to the qualification and obligation requirements. First, as I mentioned before, reverse mortgages are just mortgages. And I say that because in terms of the ownership of your home, reverse mortgages work the same way as a regular mortgage. You retain ownership or the title to your property if you get a reverse mortgage. There is a major myth out there that has folks thinking they lose ownership, and that is not the case at all. Secondly, the idea that you are automatically giving up any inheritance to your children or heirs is also misleading. As we talked about previously, most folks have an increasing loan balance with a reverse mortgage, but that does not mean that there will be no equity left at the end of the loan for their children. Keep in mind, as your loan balance appreciates over the years, it is very likely that so will your home's value. As well, the federal government has done a really good job as far as changing the structure of this loan over the years to where it is more likely that there will be equity left at the end. And don't get me wrong here, there will always be a risk of becoming upside down on the loan because that is the risk with any mortgage, and especially one with a loan balance that is increasing over the years. What I am saying is that This is not a hard line in the sand and is actually something you have quite a lot of control over. And as you learn more about this product, you'll begin to understand what I mean by that. Additionally, the fact that this loan is federally insured means that even in the unlikely event that you become upside down on the loan, or in other words, you owe more than your home is worth, you nor your heirs can ever be personally responsible for any loan deficiencies that the sale of the home cannot satisfy. In layman's terms, that just means if you wind up owing more than your home is worth, the federal insurance will pay the lender whatever the sale of your home cannot pay for. So this feature ensures your children or heirs cannot incur debt from this loan. All right, let's move on to the qualification and obligation requirements of the loan. Now, in order to initially qualify for a federally insured reverse mortgage, you must first be a homeowner that is 62 or older. With that said, if you are married and one of you is not yet 62, that doesn't mean you can't do a federally insured reverse mortgage. That just means that the spouse who is 62 or older would be the only one that could be considered a borrower on the loan. The younger spouse would be considered what is called a non-borrowing spouse, which comes with a few distinct differences from a borrower that you will want to make sure you know about if you fall into this category. This is a bit long-winded for this video, however, so if you want to know more about the non-borrowing spouse designation, feel free to reach out to me anytime. Additionally, the home must be either a single-family residence, a 2 to 4 unit dwelling as long as you live in one of the units, certain condos, and certain manufactured homes. And the home must be and always remain your primary residence. And primary residence is generally described as the home you live in for at least 6 months and 1 day out of the year. So for those wondering if you can have a second home that you spend a few months out of the year at or go on extended vacations, yes, of course, you can still do that. As well, similar to other mortgages, you must keep the home in good repair. And lastly, this is a big one and also is one that has surprisingly caused much of the controversy that has been had over the years. And is also a requirement for other mortgages. But you must keep up with your property charges. So paying your property taxes, homeowners insurance, HOA dues if you have them, etc. And yes, again, this is the cause for a lot of the controversy or negative stories you may have heard about in the past about people losing their homes to reverse mortgages. Well, in many of those cases, the homeowner was unfortunately not able to keep up with those property charges, and the lender eventually foreclosed. And I point this out only because this is understandably one of the biggest fears people have. But as long as you adhere to the things we just talked about, you don't have anything to fear. This leads us to what can and does cause the loan to become due. And remember, with a reverse mortgage, when the loan becomes due, the whole thing will have to be repaid all at once, including the amount borrowed, plus any fees and interest that had been accruing for however long you were in the loan. And as I mentioned before, the loan becomes due generally when the last remaining borrower leaves the home permanently or sells. Selling of the home is pretty self-explanatory, although just to get a bit more specific on this, you can sell your home anytime after you get a reverse mortgage. You could pay it off at any time. You can refinance your reverse mortgage or refinance into another type of mortgage if you wish. And there are never any prepayment penalties. And leaving the home permanently refers to things like the borrower passing away or maybe going into a retirement home or something of that sort. And just to clarify, as I get this question a lot, If you are married and you are both borrowers of the reverse mortgage, both of you would have to pass away or leave the home before the loan would become due. So, if one of you passed away or had to go into a care facility or something like that, the other spouse, as long as they were still living in the home and adhering to all of the reverse mortgage requirements, would just continue on in the loan as before. And the only other way the loan would become due is through foreclosure, meaning you did not adhere to one or multiple of the requirements of the loan. Now, once the loan becomes due, what happens? Well, it of course needs to be repaid somehow. Many times, this is the heirs that are needing to take care of this. So, that repayment can come in the form of selling the home, repaying whatever is owed on the loan, and keeping the remaining equity and moving on. Another option would be getting another mortgage to pay off the reverse mortgage. Generally, that option is used by heirs who want to keep the home, or heirs could get their own reverse mortgage if they qualify and pay the parents' reverse mortgage off that way. And lastly, if they had just a lump sum from savings or wherever, they could repay the loan that way as well. Finally, let's chat about who this loan may be a good fit for. And contrary to what many people believe, a reverse mortgage is not or should not be a means of desperation or a last resort. And although this loan can be incredibly helpful for those who are in dire need, my hope is that as more and more people become educated on the topic, they will see that it is a great means of either preventing financial distress in the first place or a means of strategically enhancing your financial plan throughout your retirement. With that said, I'm certainly not one who believes that a reverse mortgage is a great fit for everyone, as I know it's not. But I do wholeheartedly believe that the general population needs to become more informed on the topic, as there are many different uses and strategies to be utilized with this financial tool. And there are way too many folks out there right now that would greatly benefit from one of these uses or strategies that won't ever get the chance to because of a lack of knowledge on the topic. So, those that may benefit the most from this loan would be folks who plan on staying in their current residence long term, who may have most of their wealth tied up in their home with no way to get access to it, or folks who may be concerned that their retirement income will not last or that retirement income is not sufficient to pay for their desired lifestyle. Additionally, this loan may also be fantastic for retirees who actually have a lot of retirement savings and want an additional tool to help better manage their retirement portfolio, as reverse mortgages actually have many financial planning benefits. Lastly, as I mentioned in the beginning of this video, I was going to be discussing who a reverse mortgage may not be a good fit for. And in general, this loan would not be a good fit for those that the loan does not provide a sustainable solution for. So that could be someone who is not planning on staying in the home long term, someone who would not get enough financial benefit out of the loan to put them in a sustainable financial situation in the present or future, or it is especially not a good fit for folks who do not understand how the loan works. And if it is one piece of advice I can give those of you who are just beginning your research into reverse mortgages, it is to make sure that you thoroughly understand the ins and outs of how this financial product works. That way, you can truly make a confident decision about whether it's a good fit for you or not. So learn as much as you can. And the best way for you to learn more is to make sure you subscribe to my channel if you have not already. Once you subscribe, you'll have easy access to the many educational videos I've done in the past that you can watch at your leisure. Additionally, if you ever have any questions regarding reverse mortgages, you can always feel free to reach out and speak with me personally. I can be reached at 888-982-0475. Until next time. Take care.